Hey everybody, good afternoon. We have a glimpse at a very important upcoming Fed meeting and a lot of jobs data to unpack here today. My name is Brandon Steele, financial advisor with Mainsail Financial Group here in Bellevue. And our goal every Thursday is to bring to you the market news, data, trends that we're watching, and hopefully weed out a bit of the noise along the way. I hope you are all enjoying the holiday season. It's like full force now, it feels like, as we move into December. And definitely starting to feel more like the holidays. So I hope you're enjoying time with friends and family to kind of wrap up the year here. We want to really unpack a lot of jobs data that has come out over the last week, and then also tie that in our question of the week on how that relates to the upcoming Fed meeting. So before I get into the jobs data, I want to discuss a couple more broad items, or one more broad item, which is the ISM services number recently. The reason I wanted to share that is that there's this constant conversation about inflation, which also factors into the jobs and the Fed decision and all that good stuff. And basically what I wanted to share is that it's becoming very clear that this inflation thing is going to continue to persist. You know, we've been talking about that, as you know, for quite some time. And I think that it's becoming more and more evident that that's the case, because what's happening is these inflation factors are not just around energy or just around services. Like, they're starting to really broaden out where we're seeing the inflation impacts. It's not just food anymore, right? There's a lot more broad inflation, widespread inflation that we're seeing. So that is really important. And I think that's why the Fed has been so aggressive with this. Again, I think that there are maybe other ways that could help handle the inflation impacts, but regardless, that's why the Fed has been very aggressive on their rate hikes. Okay, so with that said, one of the big reasons that the market has been up and down and the Fed has been able to be really aggressive is because the jobs market has been really strong. Okay, so let me go back. Last Friday, on I think it was the 2nd, we had non-farm payrolls numbers come out, and non-farm payrolls added 263,000 jobs. So as a heads up, very different than what the ADP employment numbers showed last Wednesday. A very different tone, a big number of added jobs, and we have seen the markets really pull back since then. Okay. Fast forward to today, on Thursday the 8th, and basically we had an initial jobless claims number today that was basically in line with expectations, but it's the highest number that we've seen in, I think, 10 months or something like that. So jobless claims obviously means it's negative sign for the jobs market, whereas non-farm payrolls is adding jobs. So today we saw the market pull back on the positive jobs data on Friday, and today we see the market pick up on a negative jobs number today. So what I wanted to spend some time is talking about why that's the case. Okay, again, it's a really weird scenario we're in, where really good news is bad news in the short term and bad news is good news. So the reason that's the case is because everybody is watching the Fed. And really, the Fed has driven the markets this entire year, you know, probably the last 2 years, but let's just say this entire year. And what is happening is the Fed has been very clear that they're going to be really aggressive on raising rates, and basically that they know they have the room to do it because the labor market has been so strong. So when we rewind back to Friday last week and we see a very positive jobs data point come out, that's why we see the markets pull back, is because the markets are saying, well, that means the Fed's going to continue to be aggressive. They're not going to be worried about hiking too fast. They're going to focus entirely on inflation, basically under the understanding that they aren't going to impact, or it's going to take a while to really have a negative impact on the jobs market. Again, fast forward to today, we had good news. Jobs comes out, jobless claims come out. I'm sorry, bad news. We had jobless claims come out at a higher number than we've seen in the last 10 months. And we see the markets pick up because now the market is saying, well, maybe the Fed is going to have to peel back a little bit because jobs market is starting to cool a little. Okay. So it's really important to think through that, because as we gear up for the Fed meeting coming up next week, this is really a big factor in their decision on Tuesday, and then the press conference on Wednesday. So keep that in mind. This jobs data although it may seem really backwards that a good number equals bad things in the market, it's the way it is. And the reason for that is because the Fed is really like one of, if not the sole driver right now, short term, in terms of market volatility. All right. So gearing up for next week, we've got a lot of data points coming out. We have PPI, CPI, and of course the Fed announcement and press conference as well. So we'll get some data points ahead of them. If they're lower than expected, you could probably expect to see the markets rally a little bit. If they're higher than expected, you could probably expect to see the markets pull back a little bit. But of course, that's very short term. It's all going to be based around what the Fed says next Wednesday. All right. So the question of the week is a great one, and it's basically a question of what to expect from the Fed next week. And let me preface this by saying I have no idea, but I think that I have a strong perspective on what may come, and really it's based around what they've been telling us, which I know sounds crazy. What we've seen the last month or so, well, no, year or so, is just crazy speculation around what the Fed is going to do between each meeting. And the Fed this entire time, although again, there's some challenges I think with what they're doing, but regardless, they have been very clear on their path. So what we're seeing constantly is this push and pull. We see the Fed saying what they're going to do, what their plan is, being very clear on when and how much they're going to hike. The markets don't like it, they pull back. And then we see a data point come out, like one data point, and all of a sudden the market thinks the Fed is going to completely reverse course. And that's why we've been in this range for so long now, is it's entirely speculation. There's more to it than that, obviously, too. But a lot of it is speculation around what the Fed may or may not do and what the Fed does or doesn't say, right? So going into next week, Wednesday is the big day. I think that they're going to raise rates by 50 basis points. I think that because of what we see, they're going to be, again, very clear that the path is to continue to raise rates maybe at least once or twice more, and say that they were going to reassess as they get the data. Like they could talk about that all the time. I think they will continue to hammer that point. But nonetheless, what I think they will talk about is that they believe that we need to get to a higher rate before the inflation story really starts to tame. Higher than they expected. So I think we may hear a lot of word around that. But again, remember, just because they're slowing the rate hike doesn't mean they're stopping the rate hike. So there's a lot of misconception around that, but I do think they will slow to maybe 50 basis points and continue to hike maybe for at least the short term moving forward. So I hope that's helpful. We will be back next Thursday at 3 to debrief on the Fed meeting. This is the first glimpse. Again, obviously, I don't have the insight on what's going on here. But next week, next Thursday, we will be talking about exactly what the Fed does and doesn't share and what that might mean for you moving forward. Have a great upcoming weekend. We'll see you next Thursday at 3.